Welcome back to the Paper Gain Show for those with 1 to 10 million in investable assets. I'm joined by Bobby Brown. Jonathan couldn't make it this week, and so we've got a fill-in and excited to jump into allocating assets across your various goals. How's it going today, Bobby?
It's pretty good, Matt. Appreciate you having me on. Excited to be the guest for today. So
Yeah.
happy to get into it and see what happens.
Yeah, absolutely. Let's jump right on in. I know you do this all day, every day, just like myself, but I really wanted to start out with kind of the various buckets, depending on what your goal is, as well as the tax considerations. So really, we're going to hit on three things: lifestyle, growth, and legacy bucket, as well as some tax efficiency across the board. So wanted to see if you had seen any best practices as it relates to lifestyle.
Yeah, really with lifestyle, it's really getting started with a basic budget. Having the clients come in and understanding what their cash flow needs are. Everybody wants to hop into the markets and make a lot of money, but really you have to understand like what are my monthly expenses, what are my annual expenses, and then start allocating funds, kind of compartmentalizing them in your head to determine, what's going to be the best place for these assets that I may need in the next 1 year, 3 years, because we don't want to risk those. If you're not looking for a 20% or 30% loss in funds that you're going to need in the short term. So just having them put a budget together, understanding what that looks like for them. Every family's different, every person's different, and starting at that point seems to be a beneficial starting point for most clients.
Yeah. Yeah, I consider that the foundation, if you will. And just like you, I mean, I've seen people manage that any number of ways, from keeping a significant amount of cash, sometimes a couple 100,000 just in their bank account or in like a holding style account, to rolling CDs, treasuries, you name it, and allowing their other assets to be focused on that growth. And it just gives them that peace of mind to let everything else keep compounding.
Right. Yeah. And good point. I mean, whether it's just holding cash in the bank and you're happy to see the minimal interest that you earn, or staggering out some CDs or treasury bills so that you are earning a little bit higher than 4%. I mean, we've been in a great rate environment for the last few years. Obviously, that's looking like it's going to start coming down. But it's a good place to put some cash away and just keep it, until you actually need it. So again, budgeting, understanding monthly flows, quarterly, annually, you can kind of stagger your CDs and treasury bills and earn some interest right now. So that's been nice for clients.
Yeah. Any tax considerations? I know a lot of that's more about safety of the principal. And so there's going to be interest, that's going to be ordinary income. But any creative tax solutions that you've seen as it relates to, call it that foundational cash element?
Yeah, really, it's just for most of our clients, it's just letting them know up front, like, don't
Yeah.
forget that the tax man's coming,
Yeah.
because a lot of people, they see what they've earned and they may shuffle that and move it into another account if it's not spent. And come tax time, you just got to be upfront with them and remind them, that's no free lunch.
Yeah.
You may love the returns that you're getting just in terms of your cash. You got to keep some aside, and paying tax isn't always a bad thing. You're making some good money. There's other ways, through the course of the rest of the assets to definitely shelter some of that tax away.
Yeah.
But being cognizant of the other ordinary income that you are generating. If you are holding some other assets and you've got dividends and interest coming there, that's where you can start to play with putting those more into some growth buckets. So, if we get into that next, I think from the foundation into that next layer of like your growth buckets, what does that look like for you may help as well.
Yeah. I know this is where you spend most of your time, especially uh, focused on the investments. But what are you seeing as it relates to that growth bucket? Obviously, the goal is to outpace inflation and uh, really grow the assets.
Yeah.
Anything interesting there?
Yeah. In the growth bucket, it's, you definitely want to outpace inflation. And with higher interest rates, historically, we've seen these markets perform better because that risk-free rate environment is elevated. So you're seeing numbers that are higher than they have been historically, which has been nice. A lot of times, again, it's just level setting with the client. All good, good times don't always last. And so even though you're wanting to keep up and outpace inflation, you want these growth numbers, you may overextend yourself a little bit into more risky environments like a lot of tech names. So keep the fundamentals in mind and always kind of dial back. But it's been a great growth environment over the past few years. So a lot of happy clients out there, but it's
Yeah.
always remind them bad times do come. They may be short lived or some a little bit longer than others, like an '08 or a tech bubble. But they
Yeah.
will happen, and then you got to stay the course.
Yeah. 2022, but I feel like people have already forgot about
Yeah.
that. Even though that was, I mean, it wasn't that long lived, but it took about a year.
Yeah, and it was a sharp downturn. I mean, a lot of people, and on both sides, on the stocks and the bond side. I mean, it was, and inflation was eating away your cash at the same time, so it was like a lose 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 kind of across the board. But we were very in touch with our clients, very communicative with them, just telling them, hey, we know these times are going to pass. That's why we had the foundation, like you talked about, some of those cash assets set aside, so that we didn't have to necessarily withdraw off of portfolios. And then holding dividend stocks through that time period helps because you at least get to see some return of capital during those time periods. But a lot of people seem to just kind of put that one out of their mind so quickly because we have had a great back to back. And even this year has been very tremendous in the market.
Yeah, for those that are more charitably inclined, like, have you seen anybody, like, pre-planning gifts or using donor advised funds, appreciated securities, taking advantage of those highly appreciated, typically tech stocks is the most common that at least I see, but is that
Yeah.
something you're seeing as well?
Yeah, absolutely. Any of your tech index ETFs or funds, or even just your individual stocks. I mean, your Nvidias, people don't want to necessarily sell those off because it is still continuing to show great signs of strength as a position. So it's, how do we move those around? How do we have purpose behind what we want to do for your future? If you want to have a legacy, do we put that in a donor advised fund and we earmark it for something? You don't have to sell it off. And even if you do transfer it to them and they do determine to sell it off, an association foundation, you don't have to take the tax bill. So you get to complete kind of your request that you have, you're passing on of assets that you had planned for some time, and it's given people a lot of great opportunities recently to do so.
Yeah. Anything from the tax standpoint for this growth bucket specifically? I know there you might be in more equities or funds, but there's always capital gains. Obviously, uh, ETFs are more tax efficient than
Yep.
mutual funds, but anything else that investors kind of in that 1 to 10 bracket might not be aware of or kind of forget about.
Yeah, tax loss harvesting is big, and for individual managers that are holding stocks, or even if you have your own individual stocks, taking a look at selling out of something if it has a loss. Some of the stocks just haven't had the performance over the last few years, so you could take those losses and set them aside, get back in
Mhm.
into those same names after 31 days or so, and let them try to rip again. So it's just having an advisor or talking to somebody that has the understanding of tax loss harvesting, allocating assets in qualified accounts versus taxable accounts. How do you want your dividends and interest paid to you? How do you want your capital appreciation taken into consideration? So that's one of the challenging aspects after really good markets and you have taxable accounts. How long do you sit on positions? Were you buying in over time? Do you have tax lots that look a little bit better than others? Making sure you've got some long-term tax lots in there and looking at those first. But again, putting a team around you that can take all that into consideration and work over time. It does take a lot of time and effort to fully understand that and keep up with it. So nice to have a team behind you.
Yeah, absolutely. All right, the final bucket, the legacy bucket. I know obviously the easiest account from a tax standpoint is the Roth for this bucket, but beyond just letting it rip in all equities, what have you seen here for clients kind of thoughtfully planning for that next generation or planning for assets that they never plan to touch here?
Yeah, there's a few different things. I mean, like you touched on, obviously the Roth is a way to just let that thing go and be as risk on as you can be, making sure that those funds are kind of out of sight, out of mind that you're not going to need them. Obviously, 529s have been a great tool for education. And now, so with the changes that have come out in the Secure Act, where you can utilize those funds for Roths in the future with certain limitations. I mean, that's been a huge benefit for clients. And then, like we talked about, advised funds, foundations, we have a lot of people that are very charitable inclined. And, come the end of the year, I have my RMDs. I highly appreciate a stock. What am I going to do with them? Shuffling those around in different areas. Again, having people on your team that can help you through that. Those
Yeah.
are some of the few that we've looked at and had in the past few years.
Yeah, my big takeaway is even if you are hands off and passive in your investment approach, there's a million different little decisions based on the various buckets and being very thoughtful. And specifically for those in that 1 to 10 million range, these are some of the biggest mistakes that I typically see is poor asset allocation, not being thoughtful, and what you're doing in the various buckets, or investing all three, your Roth, your IRA, and your taxable account, all the exact same. Is just some low hanging fruit to consider, and just have, like you said, professionals take a look at it and give you some ideas.
Yeah. Yeah. I mean, you have to be intentional when it comes to investing. Obviously, worked very hard to get to that spot. The 1 to 10 million space is a lot of people that have worked really hard for their money. Obviously, don't want to just squander it away. And there's a legacy, a growth, all these things that you want to take into consideration. And it's really just being thoughtful and having intention behind what you're doing.
Yeah,
Like I said, passive and investing can be good. Buy the index and you've done well,
good.
but you have to be intentional with other things, your tax overlays, your legacy gifting, your estate tax considerations. Once you start pushing that upper bound of the estate tax, that can come in and eat away about almost half of your assets, if you're not careful and don't pre-plan. So
Yeah.
something to definitely start looking at around that $1 to $10 million space.
Well, appreciate you filling in. And as always, please subscribe.
Oh, absolutely. Thank you for having me. It's been great.